If you want returns that are going to beat the market, if you want 20% returns, if you want 30% returns per year, you can do that. But usually it's going to involve taking on a lot of risk. Similarly, if you only want the tiniest amount of risk, if you want the safest portfolio possible, usually that's going to be at the expense of your returns. The more returns you want, generally, the more risk you're going to take on. Risk parity is a way around that. It's a way to decrease risk while increasing returns. It was pioneered by Ray Dalio, one of the richest people in the world, founder of Bridgewater Associates, the legendary hedge fund. They put out these two papers called Risk Parity is About Balance and Engineering Targeted Returns and Risks. I'm going to take you through them in this video. Each asset that you have the option of investing in has a risk-return ratio, right? So with stocks, you have this amount of risk for this amount of return. Generally, the more return you want, the more risk you take on. And inversely too, the less risk you want, the less returns you're going to get. You can manipulate the actual values of return and risk for any asset just with capital allocation. So with 30-year treasury bonds, for example, if you want less risk, well, you can put in less money. Right? If you just put in 50% of your portfolio, you're going to get 50% of the risk, but you're also going to get 50% of the returns. Similarly, if you want, say, 70% of your portfolio, then you're going to get 70% of the risk and 70% of the returns. This is just capital allocation. You can do this the other way too, which is what hedge funds do. By using leverage, you can increase the risk and increase the return. Each asset has this fixed risk-reward ratio. Right, and you can have anywhere along this line, you can have whatever risk you want and whatever return you want. But generally speaking, it's just going to stick to this line and it'll go to infinity. But if you want returns without the risk, you have to get a way to get a better risk-return ratio. That's where diversification comes in. Diversification is the only real way to reduce risk without reducing returns. If you have a 50-50 mix of bonds and equities, you can see that over the financial crisis, when equities did very poorly, bonds did very well. And the mix of 50% equities and 50% bonds, that's going to just perform, well, like this little grey line here. Less risk, but bonds have less return. The reason why it decreases risk is because bonds do very well in periods of decreasing economic growth. Stocks do very well in periods of increasing economic growth. They are kind of inversely correlated. They move inversely to each other while still making money. If you have a portfolio of 100% stocks and you add in bonds, you're going to decrease both the risk and the return. Interestingly, and this is the really important point here, is that this is the effect of diversification when you get to here. Okay, you get 25% stocks and 75% bonds. A portfolio of just 100% bonds is actually more risky for less return. Right? That's because it's not diversified. That's because stocks and bonds move inversely to each other. Right? They're decorrelated. With leverage, of course, you can increase the amount of risk that these bonds have and the amount of return that these bonds have. So you can get the same amount of return as stocks with bonds if you just use leverage. But with diversification, you can get the same amount of return with stocks as you do with this portfolio of 25% stocks and 75% bonds, but with significantly less risk. That's because of diversification, right? That portfolio gives you less risk than just equities without less return. This is because diversification reduces risk, and usually it reduces risk at the expense of return, right? Well, it actually doesn't. Diversification improves the risk-return ratio. If you use leverage to then get the return back up to the same point. See, most people think of leverage as being risky. Well, in this scenario, leverage does increase risk, sure. It also increases return. If you use leverage in order to diversify more, that reduces the risk overall. Okay. A diversified and leveraged portfolio is less risky than a non-diversified and unleveraged one, and it produces returns just as good or even better. I mean, you can use as much leverage as you want to get as much returns as you want. but it's also going to increase the risk. So you can basically engineer this portfolio to have as much returns as you want and as much risk as you want, just because of using leverage to diversify more. What if we can diversify even more than just stocks and bonds? Because stocks and bonds, that's half of the economic equation, right? Economics is not just about growth. Inflation is also a significant part of the economy, and both stocks and bonds do well in periods of rising inflation. What about periods of falling inflation? Then you can diversify into those assets too. We have these 4 quadrants here. Basically, these are the four seasons of the economy, right? The 4 types of markets that you're going to encounter, either periods of rising growth, falling growth, rising inflation, or falling inflation. These are the 4 main economic variables, right? The 4 seasons of the economy. Risk parity is about allocating your capital so that each quadrant comprises 25% of the portfolio risk. Basically, you're spreading your risk so that it is equal among all possible economic environments. All seasons of the economy, you are spreading your risk so that you won't have a vulnerability to any particular environment, performing well no matter what. See, most people's portfolios do really badly in times of recession. That's because most people's portfolios are equity heavy, right? Their risk is concentrated into one area. Risk parity is about spreading that risk out, diversifying so much so that you have this parity of risk. And it's not about capital in this sense. When it says 25% of risk, that doesn't mean you put 25% of your money in that quadrant. That means 25% of your risk. So obviously stocks have a high risk level. That means that if you are going to do this strategy, you can't put that much money into stocks because they have a lot of risk. You want those stocks to comprise 25% of the risk of that portfolio. What this works out to, if you actually do all these the mathematics, and you work out how many assets you'd need to get to comprise these 25% quadrants, you'd get 30% equities, 40% long-term bonds, meaning 20 or 25-year treasuries, 15% intermediate-term bonds, 7.5% gold, and 7.5% commodities. This portfolio has the best risk-return ratio. Right, going back to this chart, this portfolio is going to do very, very well. A traditional portfolio of stocks and bonds is going to have about this much risk with this much return. If you use leverage on all of these different asset classes so that they have a 10% expected return, the portfolio that you create from combining all of these together is not going to be in the middle of these in terms of risk, right? It's not going to be the average amount of risk of all of these because of diversification, right? Diversification reduces risk. So this diversified portfolio is going to have 10% returns because you've leveraged it to 10%, but with significantly less risk. And of course, if you don't want to use leverage, well, you can use less leverage, you can use more leverage. You can engineer this to suit whatever returns and whatever risk levels you want. It's about getting the right risk-return ratio. And this is how this portfolio performs. It's the blue line here. Ray Dalio calls this the all-weather asset mix because it's for all possible seasons of the economy or any weather, this performs well. And as you can see, it's such a lot less risky than just equities alone. Comparing it to a portfolio of stocks and bonds, and by the way, this is leveraged so that it has the same amount of returns, right? It has the same return level. What if you leverage it so that it has the same risk level? Well, then it's going to significantly outperform, right? This red line is the stocks and bonds together. That gets to, 350% maybe total return over 40 years. This blue line, the all-weather asset mix, goes to above 500%. That's a significant outperformance. And this is just by using risk parity. Basically, all you're doing is diversifying. but you're diversifying so that among any economic scenario, you don't have a significant vulnerability in the amount of risk in your portfolio to that economic scenario. Okay, in any economic environment, you have the same amount of risk, no matter what happens, whether it's a recession or a time of deflation. Your portfolio is going to perform roughly the same. Thanks for watching this video. If you learned a lot, hopefully you'd want to subscribe so you don't miss out on more videos on learning how to get a lot of money without the risk. Thanks for watching. See ya.